Hello, class. This is our sixth lecture series on financial accounting or principles of accounting, and I'm your instructor Jamal Hyder. So, in our last lecture, we were trying to understand what are the what do we mean by adjusting the account, and then we talk about the four entries or four type of transaction which needs to be adjusted. So number one was prepaid expense. So we talked about that. When prepaid expense happen, we first record that expense because we need to apply revenue and expense recognition matching principles, right? So first, when prepaid expense happen, we record it as prepaid expense to cash, and it can be any expense: prepaid rent, prepaid electricity bill, prepaid wages we paid, whatsoever, right? So later on, when the expense is actually consumed, or when the prepaid account prepaid is there is a decrease in prepaid value, so that becomes your now actual expense, because now it's the time we can convert that prepaid into real expense. So apply expense recognition principle here. So later we convert that expense into expense. So prepaid our assets. So assets going to reduce. So this is on balance sheet. So on balance sheet we need to reduce those prepaid, and expense account, and we create expense. Expense directly goes to income statement. So then we talked about unearned revenue. So our unearned revenue, so when first occurred, we talked about earlier a number of times that unearned revenue is our liability, because we still are liable to deliver the goods. We didn't deliver the goods, we just received the cash, that's it. So we create a liability here first, and then we deliver the goods, we decrease those liability and convert that liability into our revenue. So this is called adjustment of the account. Number third, we talked about accrued expenses. Accrued expenses, right? Expense occurred, but you didn't pay, so it means you are liable to pay. So we create a liability payable, and then we pay, we reduce that liability to cash. And then the last adjustment would be the accrued revenue, means we didn't collect. We deliver the goods, sales happen, but cash is not going to be cash inflow is not going to happen. So we create a receivable. Sale happened, so we are liable, we are obliged, we have a right to record the revenue, so we create revenue. But we didn't receive cash, so we create customer's account, which is account receivable. And then we receive the cash, we decrease the account receivable and increase our cash. So the summary of adjustment of the accounts. So we have a comprehensive question here, illustration here. So we'll just talk about that. So we continue our previous example of Friday Service, Auto Service Incorporation. So all continuing with that example. So to connect this example to previous one, so we have 600 income tax expense, and that is payable. So what would be the entry? Income tax expense to income tax payable, right? So you create first the expense, because it's not going to be paid, it's going to be paid later. When it's going to be paid later, you create liability. Expense happened right now, accrued, it's occurred, but paid later, so we create liability. And then we pay back, we decrease the cash, we decrease the liability. Simple. So here are the examples, and these are their adjustment entries. So here, prepaid rent expires, which means from that prepaid rent, 1,000 is consumed. And if we lost the value of 1,000 from our asset, which is prepaid, prepaid is our asset. It means we lost in the value of our prepaid, because that prepaid expense is now used, consumed, expired. we have different words like consumed, expired, retired, right? It means we retire their expense as an expense from our asset. So entry would be rent expense, expense to prepaid. Any kind of it can be the prepaid wages, it can be prepaid utilities, whatsoever, right? Supply used, right? The nature of supplies is a prepaid because you purchase in advance all the supplies, stationery items, rubber, pencil, papers. So we consume, we convert that into expense. So expense to the account, prepaid account, or here in this case supplies. So supplies. Depreciation on account. We also did, all these. We also did, the breakout room activity as well. So this is all that we just, revising from our last lecture. Similarly, I'm just jumping on the last one, which is accrued income tax expense 600, right? Income tax happened, we create payable. And then we transfer those adjusting entries, we post them into their relevant account, right? So you see here, the relevant expense account is open, right? Because prepaid rent expires 1,000, so 1,000 coming here, right? And at the end, what you are trying to do, you balance out to find out the balance, right? Now, so the order of our financial statements. First, we make income statement. From income statement, we calculate net income, right? Net income goes to retained earnings, right? From retained earnings, we make balance sheet and then we make cash flow statement. So up till now, we are making the income statement and we did not realize the effect of adjusting the account, right? And now we know that there are some accounts which needed to be adjusted, which are needed to be adjusted. So there are 4 types of account which is talked about that: unearned, revenue, accrued, expenses. So this kind of stuff. So it means the previous income that we just calculated was not right, because some items that are on the balance sheet, right, in the form of assets like prepaid expense, or in the form of liabilities like unearned income or unearned revenue, right? So they need to be adjusted in that case, because those adjustment account will move from balance sheet to income statement, right? It means before adjusting the accounts, what we calculated, that profit was not right. So in order to find out that, the real sequence is that first, when you are going to make financial statements, before financial statement, you must adjust the account. At the end of the year, what are the types of accounts that on the balance sheet that are needs to be previous year balance sheet that are need to be adjusted, and what are the accounts from the balance sheet that transferred from balance sheet to income statement, right? So what is a trial balance? Trial balance shows the balances of all the accounts in some orders, right? We talked about trial balance. First, we write down the balance sheet items. From balance sheet item, we start from current assets, long-term assets, current liabilities, long-term liabilities, and then we mentioned the income statement account, sales, and then expenses. So whenever we want to make statements, we don't go to the books of accounts, or we don't go to each and ledgers. We just see one nice statement, one nice trial balance statement, and then we just pick the figures and write it down. So that will basically make our lives much easier. So this is not the statement. This is just the listing of the account, so that we know, okay, what is the balance and how we are going to just took the balance from sales and put it on making the net income. So it's a net income statement. So it's very easy. So adjusted trial balance is that trial balance which are adjusted for the values of adjustment of the account. So it means in the previous trial balance, we don't have any prepaid expense account. We don't have any unearned revenue account over there, right? So we make, or we need to adjust those accounts. So here, you see, previously we make trial balance up till here. So we don't know the value of rent expense, how much, because we have prepaid rent here, right? So we don't know how much rent is going to expire this year. So you see, it's still mentioned 3,000. So these are the adjustments. So it's up to you. You want to write it down here or not? It's up to you. So it means the new balances, because these values are coming from their balances here from ledgers this month. So you see, the prepaid rent account is now 2,000. So you just pick the value here in adjustment of the account here. So you write it down. So debit balance 2,000. So you write it down here, right? And and from here 1,000 is transferred to rent expense. So in our previous trial balance, we don't have any value here, right? It means this is the new item that is coming from adjusting the account. So this is the benefit of having adjusted trial balance, right? So the order of the trial balance is, first you need to write down the assets, and first current assets. So you see current assets, and then long-term assets, and then liabilities, current liabilities, long-term liabilities, and then we have the owner's equity account. And after that, we see the income statement account. So all the accounts are here, all the titles, right? So from this, using this information, we can make income statement, we can make a retained earnings statement, we can make balance sheet, right? So it's up to you that you want to write it down, these adjustments here or not, because ultimately we are picking those figures from our balances, from posting of the accounts, right? Any question?
No, sir.
Florian?
No, it's good.
Lota?
The only question that I have is like, when you list all of this, usually like with the balance sheet, we do it in order as chronological order. Like
this is also chronological order, right? You see here, but this is not financial statement. Remember, this is just a listing of the account, trial balance. Trial balance is not financial statement. It's not required by law. This is for your own easiness, so that you don't have to go back to this mess and pick the figures and then